One of the big movers of the day. It certainly has been a huge week for retail earnings. Well, Gap shares today soaring up just about 22% at the open after the company beat on profit, but it's still forecasting a weaker consumer for the holiday season. Based on what we've seen so far, consumer spending is just a bit soft, and maybe a bit softer than we had anticipated, and is expected to stay that way. So let's talk about what it means for Gap, some of its rivals out there. We want to bring in Corey Tarlowe. He's Jefferies Analyst. Corey, it's great to see you here. So starting with Gap and what we heard last night, we're seeing shares pop in early action this morning. It was a beat in terms of what we saw on profit. The sales decline was less than expected, yet guidance was a bit muted. Do you think the reaction, I guess, that we're seeing, the hype that we're seeing at the open is warranted?
Well, I think it's a function of positioning. So I think largely many people, many investors have been very long consumer defensive names like Walmart, and have been a little bit more negative on those that skew a little bit more discretionary and where there's been inherent underperformance. And so far, what we've seen in Gap, at least as of the last quarter, was a massive turnaround at the Old Navy business. And I think that is probably the most important thing to key in on, because Old Navy represents over 50% of sales and profits for the business, we think. And it really, I think, drives the bus, so to speak, for the overall sales and profit trajectory of the enterprise. And to see after a number of quarters of same-store sales declines, to see that inflection positively is, I think, welcome news.
Yeah, about 55% of the sales for the most recent quarter, Old Navy representing for Gap. So as Marshawn Lynch would say, putting the team on its back. At the end of the day here, Corey, when you think about the fact that we're seeing Gap shares hit year-to-date high, a 52-week high as well, should investors be chasing Gap at this level?
There is some inherent risk in that because, well, there are several other banners that are also underperforming at the moment, like Athleta, which is down very significantly, double digits versus the prior year, and Banana Republic, which is also continuing to underperform as well. So overall, you're seeing, I think, some areas zig, other areas zag. And so we view the risk reward, I think, as a little more balanced at present levels.
Corey, I want to ask a little bit about the quarter from Walmart. You mentioned, the positioning impact that, has been felt on all these individual stocks. But you look at the major retailers this week, it's one of the only ones calling out major year-over-year sales increases. How did you think about the quarter, the reaction we saw yesterday, and, just where you see, that company going in the year ahead, given the kind of consumer call-outs that they had on the call yesterday?
I'm very encouraged by largely what I've heard from Walmart recently. It's very rare that a company beats on sales, beats on earnings, raises the full year earnings outlook, and trades down the magnitude that Walmart did yesterday. So to me, as I think about the prospects for this business ahead, a potentially softer economy, the benefits that Walmart could realize from consumers trading down into Walmart to drive traffic growth, all should, I think, drive better sales and profit ahead and get me really excited about owning Walmart over the next 12 to 24 months.
So, Corey, with that in mind, then, where does that leave Target? There was lots of, excitement around the profit beat that we saw. Sales, though, still just a bit disappointing. When you take all that into account and look ahead to 2024, how do you see Target stacking up against its biggest rival, Walmart?
I think what's most interesting here is that the question that we were getting into the quarter was very simple. Amid declining comp sales, can Target still drive a mid-single-digit operating margin? And what we saw both this quarter and last quarter is that the answer is yes. Because I think for many investors, the concern was amid declining sales, would profitability be sustainable? And what we've seen is that the profits have been sustainable. They've been sustainable in spite of higher shrink, unlocked by inventory management, more favorable freight, and then higher levels of sales and traffic versus pre-COVID levels. So I think the CFO cited on the earnings call that traffic, interestingly enough, versus, I believe, 19 levels through the first 3 quarters of this year is up over 20%, which is quite impressive, and I think speaks to the sustainability of the business overall.
All right, this many retail companies reporting in 1 week. Corey, I imagine this has been like a face in front of fire hose type of period for you. So we're going to send over an espresso shot, help you make it through Friday. We appreciate it.
Appreciate it. Thank you so much.
Thanks.